Hello, friends. Welcome to the Weekend Investing Daily Bite of 28th of January. And I'm waiting for this month to end because this month is just full of pain. And a lot of folks are probably feeling the pain right now. The stocks just collapsing on each other, um, not yet finding the bottom. We will essentially go through a journey today, looking back towards small cap stocks in particular, and we'll try to discuss if is there any end to this pain in the market. So this will be beneficial mostly for users who have not gone through these cycles before. And if you were to ask any experienced investor in the market, the pain so far is nowhere near what the market can give you. So from that point of view, you can either, you know, uh, say that, the markets are useless. Uh, the problem is that we only want the upside and we are not willing to take the downside. That is the main problem because the market setup or the market structure is in this way that you can't have one and not have the other. At least no investor in the world till date has been able to get only the upside and not have to suffer for some drawdown, some pain on the downside. So, given that background, given that expectation, you have to see where you stand versus had you not come to the market. That is the only sort of, in a tweet I mentioned this morning that a lot of folks are selling out of fear that I don't know what will happen tomorrow. But then, once they get out, they don't know what to do with that money. That is one. They're hoping that they'll be able to get in at a lower price. That usually doesn't happen for most folks. They're not able to pull the trigger as the market goes down and then goes back up. And three, two other ways in which people are getting out, maybe to switch to better stocks. I think that is a good switch if you're doing that. If you are switching, basically doing some asset allocations, moving money from one basket to the other, that is also a not a bad thing to do. But to just exit because everybody else is saying, oh, there is a lot of further pain, so let me get out. That I think usually hurts most people. So let's get into this video towards the second half of this second half of the video, this topic. And do read the disclaimer always, do subscribe to the channel, and let's get into the data for the day. So where is the market headed? So Nifty tried to make a huge comeback today. It in fact uh, started off in the green, and during the day it almost fully managed to close this gap that we had created on Monday morning. But then in the last hour, it just collapsed on itself, and we've closed at slightly higher than yesterday at 0.56%. So the feel good that was there in the Nifty space during the first 3-4 hours also was lost towards the end. So that is also suggestive that still a lot of selling is happening at every level. Every time Nifty tries to go up, it's smashed down. Nifty Junior closed at 0.3% higher from yesterday. So this also had gone to a newer low at, going down to 60,000 and then coming back nearly 1,000 points or more and stabilizing here for the day. Again, not out of the woods at all, but just a reaction to the last previous two sessions of drubbing in Nifty Junior. On the Nifty mid cap, we closed 0.69% lower, slightly higher from where it had reached in the first hour itself. So that is a part recovery, but the kind of fall that we've had in three sessions, that kind of a recovery is a nothing recovery really. In small cap space, it was equally bad. We've gone from nearly 17,000 to 14,800 in a matter of seven sessions. Again, a recovery was there, but it did close 1.82%. Again, in the last hour, there was more selling. So there is also sort of a domino that starts once these stocks go down, where stocks that have been put up for margin, stocks that are being taken loan against those shares. Although in small cap space there won't be that many, there would be more in large and mid cap space, but nevertheless a lot of the dumping starts to happen because there is pain somewhere else. So let's dump whatever we have in this basket. Or brokers maybe completely uh, dumping client stocks where the margin calls are not being met, where derivative losses are there. If somebody is making derivative losses, let's dump all their cash stocks, whatever he may be holding. That kind of a game picks up, and it just revolves on itself. As prices come down, margin calls are made, those are not met, hence more selling, hence more calls. It becomes a self-fulfilling cycle for some part of the time. And that's what is the capitulation in markets, is that exactly that, it's a waterfall till the selling comes to some sensible stop. So right now, extremely oversold, but no life right now in small cap space as well. Bank Nifty, as I mentioned yesterday also, is showing some signs of life, which is very good news. It's probably the only straw of hope that we have. Bank Nifty kept up there for 1.67%. RBI has pushed in through some liquidity. India yields have 10-year yields have dropped quite dramatically. I think a rate cut is now expected. Uh, but Bank Nifty also normally leads the cycle. So if Bank Nifty is giving any positive cues, maybe Bank Nifty is suggestive of some intermediate bottom of the market, at least coming soon. That's sort of the only hope that we can do right now. Advanced decline ratios better than yesterday, but still very much in control of the bears. 327 declines to 171 advances. You can see the heat map of Nifty is completely green on banking and financial companies side. Bank Bajaj, Twins, Axis Bank, HDFC, ICICI Bank, Shriram Finance, SBI all up. IT was weak, pharma was weak, autos positive, energy mixed bag, FMCG also down. In the Nifty Next 50 space, you had again real estate do well, financial companies did well, insurance companies did well, some PSU banks did very well. You had some consumer non-durables, some cement stocks are doing well, and auto stocks are doing well. What is not doing well is energy stocks. You had some capital goods, pharma, these names, and even public sector enterprise stocks did not do well. This is the sectoral makeup for the day. Pharma losing 2.3%. Pharma has lost 5% this last 1 week. Energy continues to reel down 1.4%, 6.8 gone in this week. Public sector enterprise stocks, 3 days before the budget, there is no excitement there. 1.2% down, 6.6% down for the week. IT was flattish, minus 0.6%, commodities flat, metals 0.4%. All the other ones were flat, and autos, private banking, PSU banking, real estate, these were the ones that were in the green. So on banking space, they have now erased the weekly losses. Real estate also has erased some of the recent losses, although it is still down 19% for the month gone by. Uh, this was the stocks within the real estate space that really did well. Sobha, DLF, Godrej, Macro. So this sector, while it is down right now, is showing the first signs of life going upwards. Let's look at uh, the pain in the markets now. It's a lot of pain, no doubt about it. I'm not trying to, you know, say that the pain is less or not warranted, but that's where we are. We need to be objective in terms of how we see the markets. That's all is my ask if you're watching this video and if you've reached here. Let's take small cap 250 index. This is the last 5 years of small cap 250 index. This fall was the COVID fall. Then we rallied from March 2020 till uh, January of 2022. Then we had a nice crash and we sort of went sideways after that. So a year and a half was consolidation. Then from mid 2023, or let's say first from second quarter 2023, March 23, we went into a hyper sort of a uh, positive run again, which peaked out somewhere near end of 2025 of 2024 in fiscal 25, and we have started to come off. If you just see this entire chart, just step back, see this entire chart, nothing is looking very unusual right now. Every time we've gone through a huge upcycle, we have corrected, 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 corrected. And this was, if you see the prior data here, that is also looking the same. Nothing unusual is happening. Had we been, somewhere here, that would be very unusual. This is after, almost going, let's say, after this correction from nearly 8,000, we went to 18,000. 2.5 times we went up in less than 2 years, 2.5 years, and we are basically coming reversion to the mean is happening. So what has happened? The last 1 year returns has been wiped out. So on small cap 250, we are at 0 or 2%, you can say. 2 year returns on small cap 250 is still 28% CAGR, which is way higher than the historical 16 odd percent on small cap 250. 3 year returns is now at historical average of 15-16%. 5 year returns is still at 23%. So there always, whenever the market falls, there is sort of a reversion to the mean that happens. But we can look at this very recent phenomena and say that, small caps are lousy and small caps don't give returns and I've lost my money. But the fact is that the context is important. The context of small cap is not 3 months, 6 months, 1 year investing. The context of any investing in the market has to be long term, because there are business cycles, there are market cycles. Unless you compare from peak to peak or bottom to bottom, you will not get the real picture. If you start to compare from this peak to now, that returns are really bad, or maybe this peak to now returns are not so good. You have to see from bottom to bottom, bottom to bottom, peak to peak, to see that in each cycle how much did the market do. So the comparison has to be like to like. That is sort of the first, I would say, point right here. So what we will do here in this video, uh, my team has put in a lot of effort in this. So please, if you haven't subscribed, please do subscribe. That will be motivation. We've analyzed all 20% plus falls on the small cap 100 index. That's the 100 index has the most history on NSE. So we've taken that. Uh, Time taken to hit 20% drawdown, we've calculated that. Maximum drawdown during that correction, we've calculated that. Time taken for recovery to hit a new high from the bottom, we've calculated that. And performance before and after the correction, we calculated that, so that it gives you an objective statistical framework to look at it. Let's put aside emotions, that I entered here and it's now here. Why did I enter here? 6 months, my money is gone. All those things are very emotional statements. You need to see it very objectively and then see where you stand in that. Have you entered the market with a 5 year view and now it is 6 months, and hence maybe is not the time to lament about your loss, but to make more investments, because you came in for 5 years and you were going to bring in your capital gradually. Or if you are not bringing in your capital, any more capital, that is fine. You want lump sum point to point return, then I'll wait for some time for a cycle to form. So need to be checking the the barometer at the right times. Okay, so now last 20 years of data is there, from 2004 till now. We've taken the latest drawdown on as of today, assuming that this is the today's is the maximum fall. Let us study now. So time taken to hit 20% drawdown, max drawdown, time taken for recovery. These are all the falls of the last 20 years. First fall happened in January 2024, 2004 to March 2004. It took 49 days to hit 20% drawdown. Max drawdown happened at 29%, peak to bottom. 17th May was the bottom, and new high was formed within 182 days on 21st September. So if you were on 17th May 2004 lamenting about I've lost so much money, 29% from the top, you recovered everything within 182 days after that. May 2006 to June 2006, 21 days flash crash, 34% max drawdown. Bottom made on 14 June, within 129 days, new all-time high. Jan 2008, 11 days to hit 20% drawdown. Remember that 2008 fall, but ultimately the bottom came in March 2009. So it took almost 15 months, 14 months to keep going down. It went down 77%. It was a global crisis. It was a crisis we've never seen before. Those who have not seen 1929. Recovery took 7 years, 2000 days for small caps to come back. the most painful period ever in the last many decades. 2018 Jan to May, SEBI forced small caps mutual funds to concentrate on small caps and large caps to concentrate on large caps. Hence, a lot of large caps funds had to sell small caps. 85 days it took to come down to 20% drawdown, but the max drawdown was 65%, which happened in 23rd March 2020. So COVID fall, basically that entire fall uh, was 65%. It took less than 15 months for all-time high to come again, 838 days. Maybe recovery to new highs. Maybe there is some error here, 2022 perhaps, or maybe the days to complete. We'll check this. Jan 2022 to Feb 2022, uh, the recent fall that we had in 2022, 28 days, 33% fall, and we had a new high within 400 days of going through a year and a half of wait. The current one, 34 days to get to 20%. We are now at 20%. We don't know really how far we will go, but we are very close to the average days that we have taken to come down. So we are aligned with this. Max drawdown, how much it will happen, I don't know. If it is going to be a global crisis, we may go in this territory, but if it is going to be a regular one that we have seen, then we are very getting close to it, at least, maybe 29, 30, 34%. So that's the data on drawdowns. Now let's see what happened 6 months, 1 year, 2 year, 3 year before the start of correction, because each fall is also unique to the extent that the fall happened after a huge rally or the fall happened after a sort of a mediocre rally. So in the May 2006 correction, we had fantastic gains 1 year before, 101%. This is annualized 2 year before, 84% CAGR, 101% 1 year before, 6 months before was 55%. In the 2008 crisis, we again had 62% for 2 years, 89% for 1 year, 60% immediately before. 2018 crisis, we had 53% 1 year, 38% for 2 years before. 2022, again we had 65% huge gain, 38% CAGR 2 years before. And right now we are sitting at 35% previous 1 year rise and 40% previous 2 year CAGR rise, 20% on 3 year CAGR rise. So this, and 6 months is only 12%. So versus last many falls, this time we've not seen that kind of a rise before this fall. So that probably would signal that our fall is likely to be lesser than those bigger falls that we saw. That at least one can sort of try to make out from this data. Now, if we see what is the 6 months, 1 year, 2 year, 3 year performance after the bottom of the correction. So whenever we will hit a bottom, in the 2004 crisis, within 6 months you had 58%, 1 year was 117%, 2 years later you had 106% CAGR, 3 years later you had 68% CAGR from the bottom of that correction. 2006, very similar figures, although we hit the 2008 correction before we could get to 3 years. So 2 years later also you had 38% CAGR. 2009 recovery, you had 162% within a year, 59% CAGR within 2 years. 2020 COVID, you had 144% within 1 year, 75% CAGR within 2 years. And the 2022 rise had 36% within 1 year, 51% CAGR in 2 years. So you are seeing very healthy averages after we correct. So yes, the pain is there in going down, but it is reasonably, I would say, with high confidence, you can think that whenever you will bottom, you will have some very good year or 2 years after that. So that cannot be, just wished away. Even if, let's say, I was at 100 and now I am at 70, and maybe the bottom is at 50, but I know that from 50 I'll go 70, 80, 100% within no time. So is it good to get out at 70 and then maybe see the market go to 50 and then it will race upwards and I'll not be able to catch that? So that is the kind of situation that we are in, that yes, it is very painful today, but the pain has happened in the past also, and those who went through that pain also got the gains on the other side. That is also true, and in your face. So you can't get the after averages without going through the pain. So we have had some great years in the past 4 5 years. Once this correction does bottom wherever it will, and hopefully it will happen soon, maybe not tomorrow, but maybe in 3 months time, maybe 2 months time, maybe 6 months time, I don't know. But whenever it does, you will have some fantastic years after that. That is for sure. So is that enough reason for you to dump the idea of being in the markets or being in small caps? I think not. This is the nature of the beast. It's like riding a wild horse. You will fall a few times, but then you will enjoy the ride also, right? So the pain is there for a relatively short period of time. If you see the number of years that you gain, and then you have some period of pain, the amount of pain period is less. The rewards that precede and follow this pain period are extraordinary. Let there be no doubt about it. Most people will get stuck in this painful period and throw away all their investments and say that we are not coming back to the market, this is useless, this doesn't make money for anybody. But look at the people who have made money. Look at the gurus of the markets who are sitting here for 10 20 30 40 years, and they have gone through many of these cycles, and they are multi-millionaires and multi-billionaires, many of them. So it is because they were following a process. It is because they had fastened their seatbelt, that I will not let this pain derail me from my process or from my path. That is the sort of key to winning in the market. And the fact remains that because a lot of new investors have come in the market in the last 4 5 years, and hence a lot of new learnings are there for those people. For older people, these are older learnings, but with each cycle of that learning, some new learnings are also made. So this is something that I just wanted to discuss, because I am seeing a lot of, at least on X, etc. Hopefully, most of the weekend investors are not really uh, in that kind of a phase where a lot of people are lost right now. That is there even end to this? Is there even a light at the end of the tunnel? But those who have been with structured strategies for many years, they know that this comes and goes. This is something that you have to go through to really go on to the other side. And it takes 1 or 2 cycles to really embolden yourself to go through this. It is almost like if somebody jumps into a uh, in, into a uh, into the water and has never swam before, obviously they'll be very afraid, and they'll feel like they're going to drown. But those who have done it few times, have practiced, they will basically go through it, even though it may feel a bit of a pain for them as well. So absolutely, you have to see where the markets are. And this, because small cap 100 index is also, I feel, not very representative of how much gain can be made out of this, because the good stocks go from small cap to mid cap to large caps. So a lot of these stocks keep leaving the small cap index. So while the drawdowns are real, the upsides a lot of times, because the rebalances of the index itself are not representative of what stocks you could have really gotten into. But nevertheless, even if we discount that factor, uh, you have to really just wait this out. There is absolutely no reason to think that there is no light at the end of the tunnel. Let me know your thoughts in the comments. Do share your experience, and I'll certainly answer you there if you have any questions. Thank you so much. Thank you for watching. Bye bye.